Most people think that when you buy a Tesla, you're simply paying for a high-tech vehicle. But the truth is, Elon Musk has pulled off one of the greatest maneuvers in business history. You aren't just paying for a car, you are paying for the privilege of being an unpaid data collector. Think about that for a second. While every other tech giant is burning through billions of dollars just to acquire fragments of data, Tesla has flipped the script. They've managed to get millions of people to pay them to collect the very data that makes their company valuable. This is the negative data acquisition cost model, and it is the weirdest, most brilliant business strategy of the 21st century. Just look at the scale. Tesla recently crossed a milestone that should make every competitor tremble. 10 billion miles driven under supervised full self-driving. To put that in perspective, that's like driving from Earth to the very edge of our solar system and back, and then doing it again. But for Tesla, those miles aren't just distance, they are lessons. Every turn, every sudden brake, and every avoided pedestrian is a data point fed into a massive AI brain. In today's episode, we aren't talking about car manufacturing. We are decoding how Tesla is using your money to build a data empire that no one else can touch. Why is this data moat more important than the car itself? And how does it turn Tesla from a car company into a literal money-printing machine? Let's get into the numbers. To understand why that 10 billion mile figure has Wall Street analysts losing their minds, we have to look at a metric most retail investors completely overlook: data acquisition cost. In the world of artificial intelligence, data is the new oil. But here's the problem. Oil is expensive to drill. For any other company trying to build a self-driving brain, getting high-quality, real-world data is a massive financial drain. They have to hire drivers, build specialized test fleets, and pay for every single mile recorded. Now, look at Tesla. They've achieved what we call a negative data acquisition cost. Think about the sheer brilliance of this economic moat. Usually, a company spends money to build a product, right? But Tesla, they sell you the car at a profit. Then they sell you a software package called FSD for thousands of dollars. And then, as you drive the car you paid for, using the software you also paid for, you send them back the incredibly valuable data they need to dominate the future. You are essentially paying Tesla for the privilege of working in their R&D department. This is why 10 billion miles from Tesla is fundamentally different from a few million miles from a test fleet in San Francisco. When a competitor's car drives a loop around a pre-mapped city block, it learns how to drive a loop. When a million Teslas drive through monsoons in Florida, dirt roads in Texas, or the chaotic intersections of Ho Chi Minh City, the system learns everything. It's real-time, it's diverse, and most importantly, it's unmapped. Wall Street isn't just valuing Tesla on how many Model 3s or Model Ys they can bolt together in a factory. They are valuing the moat. In traditional investing, a moat is a brand or a patent, but in the age of AI, the moat is the feedback loop. The more people buy the cars, the more data Tesla gets. The more data they get, the better the AI becomes. The better the AI becomes, the more people want the cars. And every single step of that loop generates cash instead of burning it. But here is the billion-dollar question. If Tesla is printing data for free, what does that mean for the giants who have to pay for it? To see just how deep this rabbit hole goes, we need to look at the David versus Goliath battle happening right now in the streets of California.
Because while Tesla is leveraging the masses, their biggest rival is taking a very different and very expensive path. Let's talk about Waymo. But wait a minute. If you follow the tech world, you've probably heard the big counterargument. Waymo's technology is better because they use LiDAR. And on the surface, that makes sense. LiDAR uses lasers to create a perfect 3D map of the world. It's incredibly precise. So if Waymo is safer or more accurate, why is Tesla currently winning the financial war? The answer lies in one word: scaling. To understand the pressure on Alphabet, Google's parent company, you have to look at their CapEx, or capital expenditure. Waymo's model is what we call asset-heavy. For every new city Waymo wants to enter, they have to buy a fleet of expensive Jaguar I-Paces. Then they have to retrofit each car with a LiDAR suite that costs tens of thousands of dollars per unit. And finally, they have to pay a team of technicians to maintain that specific fleet in that specific city. It's an astronomical burn rate. Alphabet has spent billions, and while the tech is impressive, the expansion is slow. It's like trying to build a global railroad by hand carving every single wooden tie. Now, look at the Tesla chart. Tesla is asset light. Tesla doesn't buy the cars. You do. Tesla doesn't pay for the maintenance. You do. And Tesla's hardware, it's just a set of cameras that cost a fraction of a LiDAR sensor. Musk's bet is that AI vision is all you need if the brain behind it is smart enough. By ditching LiDAR, Tesla sacrificed a bit of perfection in the early days for the ability to scale to millions of vehicles instantly. Think about the math. If Waymo wants to add 1,000 cars to its network, it might cost them $100 million in upfront capital. If Tesla wants to add 1,000 cars, it costs them exactly $0. In fact, they make a profit on the sale of those 1,000 cars before they even join the network. This creates a massive capital pressure on Alphabet. Investors are starting to ask, how many more billions do we have to sink into Waymo before it returns a cent of profit? Meanwhile, Tesla is already cash flow positive on the very vehicles that will one day become their robotaxi fleet. It's a classic battle of brute force engineering versus a viral economic loop. Waymo is trying to build a perfect robot. Tesla is building a self-replicating swarm. But even with all this data, in the lower costs, there is a final boss that Tesla hasn't defeated yet. It's the wall that every tech giant eventually hits. If Tesla succeeds, we're not just talking about a better way to get a ride, we're talking about a fundamental shift in how wealth is generated. So what happens to your investment when the driver disappears completely? That's where the 90% profit margins come in, and that is where things get truly insane. So let's talk about the robotaxi endgame. So we've established that Tesla's data cost is essentially zero, but how does that translate into cold hard cash for you as an investor? This is where we move from cool technology to brutal financial reality. According to a massive report by ARK Invest, the robotaxi business isn't just a side project. It is expected to account for roughly 90% of Tesla's enterprise value by 2029. Why? Because of the fundamental shift from being a hardware manufacturer to a software service provider. In the traditional car business, the margins are tight. You build a car, you sell it, and you're lucky to walk away with a 20% gross margin. It's a one-and-done transaction. But when that car becomes part of a network layer, the economics transform.
Think of it like the App Store, but for transportation. Instead of selling the phone, you're taking a cut of every app or every ride. Software margins are typically 80 to 90%. That is where the real in-tien money printing happens. But, and there is always a but in investing, this isn't a guaranteed victory lap. There is a final boss standing in the way, the regulatory moat. While 10 billion miles is a staggering number, Wall Street skeptics are asking a very pointed question. Is it the right kind of data? You see, there's a massive difference between flat data and noisy data. Driving 100 miles on a straight, sunny highway in Arizona is easy. That's flat data. But navigating a rainy construction zone in downtown Chicago with a distracted pedestrian and a cyclist swerving in front of you, that's noisy data. These are the edge cases, those one-in-a-million situations that determine whether a car is actually safe enough to be unsupervised. The big debate right now is whether Tesla's vision-only system can solve these edge cases consistently. If they can, they don't just win the market, they own it. Why? Because once a regulator approves a system that has seen 10 billion miles of reality, it becomes incredibly hard for a newcomer with only 1 million miles to ever catch up. The regulation itself becomes the moat.
However, as we've seen in California with the new SB 915 regulations, local governments want a say. They want to be able to ticket robotaxis just like human drivers. They want to control the scale. So, as an investor, you aren't just betting on Elon Musk's AI, you're betting on his ability to convince world governments that 10 billion miles of learning is safer than a human brain. If he wins that argument, the car parked in your driveway right now could transition from a liability that loses value every day into a yield-generating asset that makes you money while you sleep. It sounds like science fiction, but when you look at the 1.7 kilowatt-hour efficiency of the Tesla Semi or the automated precision of Neuralink, you realize that Musk's companies aren't just building products, they're building a unified ecosystem of autonomous efficiency. So, after all this, the data, the CapEx wars, and the 90% margins, where does that leave us? Are we looking at the next multi-trillion-dollar empire or a house of cards waiting for a regulatory gust of wind? Let's wrap this up and look at what this means for your portfolio. The bottom line is this: Tesla is no longer just a car company. It hasn't been for a long time. When you look at that 10 billion mile milestone, don't see it as just a distance traveled. See it as the foundation of the world's largest AI network. Tesla isn't selling you a vehicle anymore, they're selling you a ticket into an ecosystem that thrives on negative data acquisition. It is a model where the consumer funds the R&D, and the R&D creates an unbeatable economic moat. We are at the very beginning of an exponential growth curve that could redefine what we consider valuable in the stock market. Elon Musk's greatest innovation wasn't the battery or the electric motor, it was this weird, brilliant economic loop. A loop where every mile driven by a customer makes the company's software more dominant, and every software update makes the hardware more essential. So, it comes down to one question for your portfolio. Are you content with paying to own a depreciating piece of metal, or are you ready to invest in a piece of the future robotaxi network? If you were the CEO of a traditional automaker right now, what would your move be? How do you even begin to compete with a money-printing machine that gets its most valuable resource for free? I want to hear your thoughts in the comments below. Is this the ultimate investment opportunity, or is the regulatory wall too high to climb? This isn't just about cars anymore. It's a battle that will define the next decade of global finance. If you found this analysis helpful, hit the like button and subscribe for more deep dives into the technologies shifting the world's wealth. Thanks for watching, and I'll see you in the next one.